everyone, I'm Karunya Rao and we're back with a brand new edition of Your Money Matters. Today we'll talk about stock market investing amid volatility with special focus on new market entrants. The past few weeks, as we've seen, have been wild for the equity markets, with concerns building up around the US Fed tapering down its stimulus measures and the emergence of new COVID variant. Both Nifty and Sensex are down 6% from their highs. So how should investors navigate this volatility, especially when they're directly invested in stocks? Mrin Agarwal of FinSafe is here to help us with just that. Hi Mrin, thank you so much for joining in. As we know, it can be quite exciting investing in stocks. And over the last 1 year, of course, many new investors have entered the world of stock market investing. Tell us, what has been your experience in dealing with stocks and what were the key challenges or barriers that you faced when you started out?
Well, I will just start by sharing my experience of what I see in bull markets, which is that everybody and their families are trying to invest. We run these groups on WhatsApp, and ever so often we are getting these messages saying that, okay, I've just opened my brokerage account. Now, can you recommend us some stocks to buy? And these are people who have not even taken exposure to mutual funds, and they're all jumping into stocks. So I think, the issue that we're seeing right now is that everybody looks at this as a golden egg and something that can just double their money very soon. And the other thing that I see is that the desire to perform all the time is usually the barrier to performing over time. And that's something that people are not keeping in mind. Like, everybody feels today that we're getting into a stock and it's going to give us some great returns in the next 1 year. But they don't remember that this can actually be one of the biggest barriers to perform over time. And I think people really need to realize that when you invest in stocks, there has to be a reason behind it. There has to be a reason for investing into a particular stock, and that it's not really a lottery ticket. So that's what it is at this point in time, unfortunately.
So then what should be the strategy for a retail DIY investor?
So the first thing, of course, is that do not buy on tips. Because a majority of people just follow tips. Second thing is figure out how to identify a stock, like how many people actually look through financials, do a comparative study, and are they even looking at the right numbers? Are they looking at the right ratios? Are they looking at the right parameters, right? So if you are planning to invest into a stock, please do it correctly, like you do research for every other thing. If you're buying a phone or you're buying a laptop, you're going to do a lot of research. The same thing applies for stocks as well. Again, can you keep up with the ever-changing themes? That's another thing that you have to think about, that you bought a stock. For example, last year, pharmaceutical was right at the top, but this year, pharmaceutical is one of the lower performing sectors. So how are you going to manage in situations like this? Again, do you have the time and resources to manage this investment? Because if you are investing in stocks directly, you will need to allocate time. You will need to constantly track markets, monitor markets in order to you take the right decision. And finally, is the allocation that you're making large enough to really impact your overall wealth? So I have seen this very often, that people have less than 5% exposure to stocks, yet they talk about it so much. And honestly, I don't think that a 5% exposure is really going to even make a material impact to a person's wealth. So I think, these are the basics that you have to ask yourself, whether you have the capability for all of this before really even starting off.
A query that we get a lot is whether to exit mutual funds and invest in stock markets. What is your view on that? What would you recommend?
Well, I don't think it's a good idea because a lot of people who are looking at doing this are doing so because they feel that they'll get a better return in stocks, but they might be comparing short-term stock returns with long-term mutual fund returns. Irrespective of that, if you are thinking of doing so, you need to figure out that do you actually have an entry and exit point? Because see, with a mutual fund, you have a professional fund manager who's taking care of these matters. But the moment you start doing this on your own, you will have to have some sort of exit point in mind, and you'll have to have some sort of strategy in mind for entry and exit. The second thing is that can you actually regulate exposure to stocks and sectors, which mutual funds do? There is a SEBI definition in terms of how much can be exposure to a single stock and to a single sector, and can you also do the same? The third thing is, can you actually beat the index consistently? And the fourth thing is that who are you accountable to? So today, a fund manager is actually accountable for returns. But when you are investing on your own, who are you really accountable to? And honestly, unless you're accountable, that performance pressure may not be there for you.
There are many influencers, or rather finfluencers out there putting out their videos on stocks. How should investors view these, and can we trust everything that they tell us, or should we take it with a pinch of salt?
Well, certainly you should take it with a pinch of salt. Have you ever seen an influencer talking about when to exit? Right? Everybody only talks about the entry point. Nobody talks about the exit point. And I think a lot of the influencers out there are actually just sharing their personal experience. Most of them are not financial advisors. They're not qualified to give advice on stocks. Many of them are sharing their personal experiences. So you should remember that the influencer's wealth and risk taking ability might be very different from yours. And as with everything else, you should figure out what would be the risk involved and what's your exit strategy finally at the end of the day.
Other than the financial impact, investing can be emotionally quite draining as well, and we rarely talk about that aspect. How can investors, especially new market entrants, deal with this?
Yeah, actually, I did want to talk about this because I see people, they get so fervently involved in stocks. And then when it's not doing well, they'll be like cribbing saying that my stocks are not doing well and stuff like that. But I think, as with everything, too much of attention can certainly lead to overreaction. And it turns out to be an emotional drain much more than what we think in our busy lives, where already work and the fast pace of life itself can be a handful. You have to really think whether you want to add this thing on to add more stress in your lives. And I think you need to really decide whether you want to get into something that is average performing, consistent on the long term, or something that's going to give you a thrill in your investing, and decide based on that. In my case, well, I'm not really a big stock investor because I think it's easier to just leave it to a professional fund manager and use the mutual fund route. And also because constantly one does not have to then keep checking what's going on and getting worried about it.